Hello, welcome to the module Finance within the MOOC Smart Light Concepts. In this module, I will explain different techniques an organization can apply when making important investment decisions. Literature is studied regarding investment decisions from a financial perspective, so-called capital budgeting. But first, before I start discussing financial topics in serious business, let me ask you a private question. How would you handle the following dilemma? Or isn't it a dilemma at all? This dilemma can be solved quite easily. What can you buy today for the 1,000 euros compared to what you can buy from it next year? Of course, due to continuously raising product prices, which we call inflation, the future 1,000 euros is worth less in terms of what you can buy from it today. So you may prefer to receive it now instead of next year. This is called time value of money, a major principle within finance theories. Let's take the example again. But now we add another possible investment, investment project B, which is expected to have the same return as investment A. However, the possible outcomes of project B, perhaps related to economic circumstances, differ from A, which is shown in this table. Comparing these investments on the variability of possible returns, we must state that investment B has a larger risk. Project B's spread of possible outcomes is larger related to project A. So taking that into consideration, what would you choose now? Obviously, that means if you look at it rationally, you would select option A. A is expected to give the same return, but with less risk. Risk aversity is the second principle within finance theory. Of course, when you can stall your money at the bank at 10%, you would prefer to put it in the bank account. Higher return and less risk. Now, let's move to serious business. This table shows examples of investments which are common in organizations. All of these need serious funding, some more than others. Why, nothing comes for free. Well, perhaps breathing clean air and swimming in the oceans. But the general aspect is that money is needed now to gain future returns. The investment budget for these investments is quite certain. Instead, the future returns are unknown. This forms the risk. Yet, the funding retrieved from the capital markets via selling stocks or different kind of liabilities will lead to certain future financial obligations. They expect future cash in return for investing the money in your organization right now. Next, for that uncertainty, investors will require a related return. In theory, we call this the cost of capital. Next to the uncertainties, the percentage depends on the time value of money. So, when should a company embrace an investment? And when should it be declined? In general, we can say that if future returns cover the liabilities to the funders, an investment project should be assessed as positive. In this sense, future returns better are determined as cash euros instead of profits. When cash is needed at the start, cash is required to pay back. To conduct a feasibility, we can follow a three-step approach. First, make a calculation of all the future cash flows which are related to the investment itself. This will need a proper insight in the detailed aspects of the project itself, the business case. Second, apply theoretical techniques to compare future cash flows to the investment budget. In this module, we discuss three possible methods: payback time, net present value, and internal rate of return. These are most often used in practice. Lastly, prepare a solid advice or decision using the outcomes of step 2. We will elaborate on this approach using a simple example in the next video. Thank you for watching.